So correction of errors is the process of fixing a mistake that's made in a financial statement. And it can be in different forms, the mistake. It could be just a transaction that's not recorded correctly, so it's inaccurate in some way. Or it could be something that you've missed accidentally. So you've excluded a transaction that should have been there. So it's important that any errors in financial statements are adjusted to make sure that it's reflective of what really happened. And that is where the correction of errors entries come in to help with that. Now, inventory adjustments are exactly the way they sound. So they're the adjusting entries that are made to account for differences between the recorded inventory items and the actual physical inventory items. So different businesses are going to have some kind of record keeping system, so they're aware of what inventories they have and how much of each type of product they have. But then you're actually going to have your physical inventories because those records may not be exactly accurate. So that's when we hear about the inventory stock take, or you might hear advertising when it says stock take sale. And so that is referring to this idea of a business checking its stock or inventory. So those words are interchangeable. And it is about seeing whether their records are accurate, and if not, what are they wrong by, what inventories are missing, or what surplus do you have of what inventories. So there are a bunch of different reasons that you could have an inventory adjustment, whether it's a surplus of inventories, so more than you had on your record, or fewer inventories than you had on your record. So you could have a surplus of inventories from production. So if the business is involved in actually producing inventories as well, then perhaps they could have made more of whatever product it is than they anticipated, and that would result in that surplus. And perhaps that just hasn't translated into being recorded in the business's inventory records. And then some common reasons why you might have an inventory loss or a shortage, which would be more common in most of the things that you'll be looking at. Things like theft, loss, and breakages. So someone could physically be stealing, or the business could be somehow just losing inventories. Things could be breaking in storage or in handling of some sort. There could be errors in the quality of items received. So this is where if you've got an external supplier or external producer of some sort, it could be about that quality issue there. And so you may have some inventories that are defective or that aren't up to standard, and that would then mean that you've got that shortage because those inventories can't be sold. You could also have expired or obsolete inventories. So this is where you can think about things like supermarkets. You've got a whole bunch of different food, and a lot of food items are going to have some kind of expiry date, or a use by date. So inventories that are expired or obsolete could be past those suggested use by dates. Another way that you can think of obsolete inventories, this is more referring to this idea that it's no longer up to date. So if you think of technology like a phone, there are lots of different versions of smartphones over time, and so if you have many old iPhones, for example, then they're eventually going to be obsolete because there are new iterations of the iPhone most years. So obsolete is referring to that idea where it's not the latest thing anymore, whereas expired is more about that that idea of sort of food and things that need to be used by a certain time. So inventory adjustments are really important for a lot of different reasons. They, of course, ensure that the business has an accurate record of the inventories that it has on hand. And that is important for a number of reasons. If you think about, again, the supermarket idea, we can often go on our phones and look at the availability of items at Woolworths or at any supermarket. The same thing for retailers like Kmart and Big W. You can go online and see um, what inventories they have um, and in what stores and things like that. So that all comes down to having that really good system that's accurate, because if customers are looking online and they're seeing that something is available, then they may go to that shop expecting to get it. And if they can't, then that's not reflecting well on the business. And it can also be the opposite way around. If the system is telling the customer that the product that they're after is not available, then that is going to mean that that customer probably isn't going to go to that shop. And if that is incorrect and the shop does actually have that product, then the shop has lost a sale there. So another thing is it's allowing the business to detect when theft is occurring. And so things can then be done and measures put in place to prevent that from happening. And it also allows the business to understand inventory turnover rates, and that is going to help with lots of decision making and lots of just operational processes. So businesses need to know what stock to order, and how much of that stock to order. And a lot of that is going to be based on demand and and things like that. So the business needs to have that really clear record of what they have, what's being sold, how much of it is being sold, and that kind of thing. So this is where inventory systems are all really important for a lot of reasons there. So closing entries are the general journal entries that are made at the end of an accounting period to close off the individual revenue and expense accounts. And this is all about preparing for the next financial year. So you think about 30th of June, there are lots of things that are happening, and closing entries is one of those things, to make sure that you're ready for the next year. So they transfer the balances of revenue and expense accounts to the profit or loss summary account. And this then allows the business to determine what the net profit is. You need to have those revenues and expenses included in your statement of profit or loss, and be able to find out your net profit from that. So closing entries also remove the balance in any temporary accounts that you might have and transfer them to permanent accounts. So one of the effects of closing entries is that every revenue and expense account is reduced to zero for the next financial year. Because when you think about the next financial year, it's a whole new period. You don't want the previous period's results to be seeping into to the next period. Whatever you look at for this financial year, you want that to be reflective of what's happening this year, without having any sort of transfer from the previous period, which would make the results skewed. Now, reversing entries are all about making sure that things are correct. So it overturns particular adjusting entries made in the previous accounting period. So they're made on the first day of the accounting period. So, for example, the 1st of July, to make sure that accurate values for revenues and expenses are recorded in the period that those revenues and expenses actually arise. And so reversing entries cancel asset and liability accounts produced on balance day. So when you think about your your balance day adjustments, you are creating temporary asset and liability accounts for those balance day adjustments. And reversing entries are helping you to cancel those. So again, you're ready for this next financial year. And we'll have a look more about the relationship between balance day adjustments and reversing entries shortly.